Hey there, and welcome to the week ahead with me, Fiona Singh-Cotter, Senior Market Analyst at City Index. This is for the week starting the 9th of February. So as always, I'm just going to ask you to quickly read through the risk warning. I'm going to put myself on mute whilst you do that. Okay, so let's just start by having a quick chat about what's been going on over the past week. So very, very choppy, some high levels of volatility this week we've seen this sort of rotation out of tech and growth stocks into cyclicals. And this has sort of very much happened following the stronger than expected US ISM PMI at the start of the week, but then more so as AI nerves hit tech stocks. So at the beginning of the week, we had the AI concerns over the impact on software companies. That was after Anthropic released an update which could replace the work of many software firms, or expected to replace the work of many software firms. So that's what hit software companies at the start of the week, putting the Nasdaq sharply lower. And then in the second part of the week, we had earnings from the likes of Amazon and Alphabet. And again, once again, the AI capital expenditure worries hit stocks. Amazon, they were trading down around 10% pre-market on Friday, and that was after they forecast 200 billion in AI capital expenditure, a third more than what Wall Street was expecting. So that obviously raises concerns again about the return on this investment, the monetization. And so this is the Nasdaq that we're looking at here. I mean, we've fallen really sharply from that 26,220 down to a low of 24,150 today. So massive decline. We have seen a sort of a bit of a recovery happening ahead of the open, but we're below that rising trend line. Momentum has sort of fallen with the RSI below 50, although we are pointing high, which suggests some sort of recovery. But I mean, you know, we're going to be watching some pretty key levels here around the 24,000 to see whether this sell-off continues. On the upside, the level that we're watching here is the one that we're just testing as we're going into the open, which is 24,700. A rise above there brings the 25,200 into focus, and if we get above that, then you know, it's looking, we're back very much into that familiar territory. But it's really interesting when you have a look at the Nasdaq chart and when you compare that to what's going on in the Dow Jones, which is much more towards cyclical stocks, little exposure to tech. You know, here we're actually just seeing the market's been trading within this familiar range that it's been in for most of, in fact, all of 2026. We haven't managed to break to record highs, but we're staying very much above the 50 SMA and also this rising trend line, which dates back to the April low. So, you know, still the move in the Dow Jones is very much muted. We've seen a resilience in the Dow Jones compared to the Nasdaq, the tech-heavy Nasdaq. This is the US dollar. We've seen a recovery in the US dollar as well. This was the 4-year low that we hit at the end of January. Seen a recovery now to a 2-week high. I think there are a couple of things going on here. I mean, obviously we've had Kevin Walsh as the Fed president. That sort of sparked the initial recovery. But also we've got safe haven flows happening here because of that route that we've seen in tech stocks. And obviously Japan we'll talk about shortly, but the Japanese yen, a typical safe haven FX, is under pressure ahead of elections this weekend. And then also we've got gold and silver, which have behaved not like the safe havens that they are. We've seen some really choppy trading. This is gold. I mean, despite these sort of really wild swings that we've seen across this week, falling to a low of 4,400, rising to a high of 4,850, currently trading around the 4,800 level. that's obviously a massive swing for the so-called safe havens, which means potentially not trading much like a safe haven at the moment, creating a little bit of nervousness, which is why, again, I think, you know, we've seen that recovery in the dollar because it is driving some safe haven flows. This is silver. Silver's actually set to finish the week 11% lower after it fell 20% yesterday. So not very safe haven. But this is quite typical in silver's behavior. You see this sort of sharp ride higher, and then it's a bit like an elevator taking it down. Just on the data front this week, we saw, as I said, stronger than expected ISM PMIs at the beginning of the week. We also saw some concerns over the labour market in the US. We had job openings falling by much more than expected to the lowest level since September 2022. We've also saw jobless claims jump to 231,000, an 8-week high. Now, the US non-farm payroll report, which would have been released today, is not being released due to the brief partial US government shutdown, which was resolved on Tuesday this week, but it just meant that the data will be delayed until Wednesday next week. Also, as far as other events this week, ECB cut rates by ECB left rates unchanged, as did the Bank of England. And then also with oil, we saw some declines in oil given the risk premium fading on oil as the US and Iran are set to meet for talks today. So what we're going to be looking for as we head into the new week is first and foremost the Japanese election. So Japanese elections are going to be held on Sunday, late Sunday, and basically Japan's first female Prime Minister, Takeshi, is seeking to secure her grip really on power with a stronger mandate. Her party, which is the Liberal Democrat Party, and its coalition party, the Japanese Innovation Party, could capture around 7,000. Sorry, just bear with me. That's better. Could capture around 300 extra seats in a 465 seat lower house. So that would give her a strong mandate. That's what the latest polls are pointing to. And that would improve her position from the razor-thin majority which she currently controls, giving her the power needed to increase stimulus spending and drive through her fiscal expansionary policies. Now, obviously, this comes at a time when Japan's debt to GDP ratio is around 240%, and the market's been fretting over rising fiscal spending since October when she came to power, sending Japanese bond yields higher and weighing on the Japanese yen. Now, Takeshi is expected to win, as I said. If she gets a strong win, improving her position, then that could drive further weakness in the Japanese yen, which has recovered. This is where the dollar sold off. As I just told you, we saw the pair drop to that 152.20 level, has recovered quite sharply up towards the 157 level at the moment, 2-week high, and we could potentially see the Japanese yen falling further if yen gets a landslide victory, or at least a very strong victory, because it's just going, and it's also less likely that the Bank of Japan is going to step in to support the yen, because we've seen household spending decline, which it fell by 2.6% year on year. So, I mean, that's not going hand in hand with further Bank of Japan rate hikes just yet, although the Bank of Japan has indicated that it would be looking to hike rates at some point, but that data doesn't mean that it's going to be an imminent hike at all. In fact, it's probably going to happen. If we do see a hike, it'll be after the April wage negotiations. The other thing with the US dollar Japanese yen is obviously to keep in mind the risk of intervention by Japanese authorities and potentially US authorities. We did see that sort of big moves, this one on Friday the 23rd, when there was sort of suspected rate check. There was a rate check by the New York Fed, which would suggest that there's a sort of collaboration between Japan and the US with regards to any potential intervention. That rate checking is often considered a pre-warning. So that's something also to keep in mind. I mean, 160 is considered widely the line in the sand where an intervention may take place. There are a couple of levels to break through above that beforehand, but we're not too far away, and sort of concerns over what Katie might do could send the yen sharply higher. So just going to push back to what's going on in the US. We've got this US non-farm payroll on Wednesday, which is due to be released. Now, interestingly, this non-farm payroll, as I said, comes after data this week showed that there are some concerns still about the labour market, which is interesting because the Federal Reserve hinted to signs of labour market stabilisation in the latest Fed meeting. So I think that's why these figures perhaps caught the market a little bit off guard yesterday. But as a result, it means there's going to be even more focus on the non-farm payroll report when it finally gets released on Wednesday. Now, as far as the December report is concerned, the economy added 50,000 jobs, and that was short of the 60,000 and below the November's downly revised figure of 56,000. However, despite weak headline job creation, unemployment was also lower at 4.4%, down from 4.5% in November. The market actually looked past the softer job creation figures and focused on the lower unemployment rate as sort of evidence that the labour market was stabilising. And as I said, that was something that was also highlighted by Federal Reserve Chair Jerome Powell. Now, this time round, expectations are for 70,000 jobs to be added in January, and the unemployment rate is expected to just tick a little bit higher to 4.5%. Now, stronger than expected jobs data could add to signs of stabilisation, meaning that interest rates could remain on pause for longer in the US. Now, I think, that could, for example, weigh on could boost the US dollar. We could see it just weighing slightly on gold. As far as stocks are concerned, I think that's the sort of data that would continue to fuel that rotation out of tech into the cyclicals and the Dow Jones, for example, compared to the NASDAQ. Now, we've also got other data next week from the US, and that's the CPI data. This is the calendar here. If we just have a quick look at what we've got going on. So we've got Japanese general election, and we've got US retail sales as well. That's going to be in focus. But we've done the non-farm payrolls, just having a look down here, US CPI data. Okay, and basically in December we saw CPI rise 2.7%. We also saw the on a monthly basis it rose 0.3%. So core inflation we saw at 2.6% and 0.2%. This was a little bit below expectations, and I think. But we're still above, obviously, the Federal Reserve's 2% target. Now, the data comes obviously after that. I mentioned that the Fed left rates on hold in the January meeting and also pointed to an improved outlook for the US economy. Cooler than expected inflation could actually help boost Federal Reserve rate cut expectations, whereas, hotter than expected data, I think, again, will just fuel those concerns over a Fed keeping, or those expectations, should I say, of the Fed keeping rates higher or on pause for longer. This is the S&P 500 that we're looking for. I mean, if you think that we're looking at, I mean, if you have a think about, what the S&P is doing compared to the NASDAQ, it's not seeing the same sell-off, but that's obviously because you've got the sort of the better mix. Not so tech focused. Obviously tech does make up a large part of it, but this isn't as tech focused as the NASDAQ, so it is holding up better. Found support exactly where we thought it would at that 67.30 level. That's the low that we saw back in December. Momentum though is, you know, falling, so that's something to be wary of. We've broken below the 50 SMA, we've broken below that rising trend line. So in order for us to be back on track, buyers need to get above 68.85. That's the 50 SMA. That's the also the confluence of the rising trend line that just dates back to November last year. Above there, then the market would be looking once again back towards the 7,000 and record highs. But you know, we're moving apart above the 6800 level ahead of the open today, which is encouraging. Sellers would need to get below the 6730 level in order to spark a deeper sell-off towards the 6600 level, and then obviously this level here, 6500, which is the lows from November, but also the 200 SMA. So that's what's to be watching out for as far as the S&P is concerned. Just to have a look at what levels to be watching out for the Dow. We're in this holding pattern. You're going to be looking out for a breakout above 49,600 on the upside to create a higher high, bringing 50,000, very much a psychological level, into focus. On the downside, break below 48,775. That's you've got the confluence of the rising trend line, the 50 SMA, and also sort of the lower band of this holding pattern. So a break below there, you know, potentially could open the doors to a move lower towards the 47,800, which was the low that we saw back in January, early January 2026 low. Below there, obviously, we could then see a steeper sell-off towards the 46,000. Just having a look now, the other thing to keep an eye out for is sterling US dollar. Now, this is interesting. I mean, we are recovering today. We saw quite a steep sell-off in sterling US dollar yesterday following the Bank of England interest rate decision. The Bank of England left rates unchanged as expected, but also downwardly revised growth, inflation forecasts, see inflation falling back to target in spring. So basically left on the table the possibility of a March rate cut. So the market's still fully pricing in a rate cut in April, but the Bank of England have left the possibility of a rate cut in March on the table. We're seeing sort of, you know, concerns over the labour market as well, which are weighing on or concerns over the labour market in the UK. I mean, unemployment's at 5.1%, is expected to rise, potentially rising towards 5.5% later this year. Wage growth is a little bit sticky at the moment, as is service sector inflation, but those could move pretty quickly to start cooling, in which case the Bank of England will be looking to reduce rates just as far as level up. And then looking ahead to next week, so a couple of things as far as sterling is concerned. I think politically, we just need to be watching out here. Keir Starmer's position is looking increasingly unstable, given the Peter Mandelson scandal. So that's something to be watching out for. Obviously, political instability is not good news as far as the currency is concerned. So if we do sort of find that that situation is ramping up, then that could put further downside pressure on the pound. Also, we've got UK GDP on Friday. Now, given that UK growth is stalled at best. I mean, we saw 0.1% growth in here we go, let's have a look. We saw 0.1% growth in the previous quarter. Oh no, that's what's expected. No, in the previous, that's right, 0.1% growth in the previous quarter. So, you know, really slow growth. We saw obviously the downward revision to growth by the Bank of England as well. So that's just not necessarily a pretty picture. So as far as levels to be watching, if we get weak growth or if we get political instability, 135.25, that's going to be a level that I'll be watching for a break below on the downside, or even sort of the 135 level. That does then expose the 200 SMA around the 134.25 level, which is also a support that's held or prevented some deeper losses on several occasions ahead of this one here, which is the 133.50. I mean, just looking at the broader picture, we're still sort of in this uptrend from the recovery from November. However, we hadn't really, we've fallen back below this trend line that dates back to the June peak. So still, we've got the 50 SMA crossing above the 200 SMA, which is generally a buy signal. So, to be watching on the upside 136.15, that's going to be a level that's take us above this resistance zone, take us above the falling trend line, and could then open the doors to 137 on the upside. Just whilst we're looking at the UK, just thinking about the FTSE 100. Now, the FTSE 100 did actually rise to fresh record highs this week. Now, if we just think about, the big moves that we've seen in miners, that had been, strong gains in precious metal had been boosting the miners across the UK. Obviously, oil prices as well had risen sharply on the back of those sort of, concerns over Iran and the US, and that sort of helped the FTSE run to record highs. But again, if we think about how well the FTSE is holding up to compared to the NASDAQ, I mean, it's quite stark that, these sort of more defensive and cyclical stocks are in favor compared to tech stocks. And obviously, the FTSE 100 has been well, left behind, one would say, in some respects, over compared to some of those tech-heavy indices in recent years, but we're starting to see that unwind. So, FTSE is definitely looking in a much better position than even the Dow Jones in the US. Just as far as the FTSE is concerned as well, I guess the other thing to keep in mind is China inflation. China inflation, it did actually tick higher to 0.8% year on year in December. China inflation is due on the Wednesday. There we go, Wednesday. Yeah, so I mean, and the December one was up from 0.7% in November, and that made it the strongest reading since February 2023. Food prices have been a key driver here, increasing 1.1% and posting their biggest monthly gain in 14 months. So core CPI, though, which excludes food and fuel, just hovered at 120, a 20-month high. So this is looking a little bit encouraging. However, it's worth noting that consumption in China remains subdued, and producer prices can also be a little bit weaker, which does raise challenges as far as lifting inflation is concerned. Obviously, the UK, as I pointed out, is heavy in mining stocks, oil majors, which tend to be influenced by Chinese data, as is the luxury sector as well. Just as far as levels, we're above the near-term rising trend line, also the longer-term rising trend line. So, uptrend is still very much intact. 10,003 level, the record high is 10,500 or just below. So that's the level that buyers are going to be looking to rise upon to bring 10,600 as the next logical level on the upside. Let's just take a quick look at oil whilst we're talking about China oil and everything else. And this is the oil markets. Obviously, as I said, we've seen sort of, that big push higher at the end of last week, then it falled lower. So what we're seeing here is the tension surrounding US and Iran. Obviously, there are a couple of, well, about 10 days ago, I think it was, maybe early last week, or late the week before, Trump announced that he was sending an armada to the Middle East. But the US and Iran are talking. Talks are taking part today. And that obviously takes some of the risk premium, as it removes some of the chances of immediate military action and reducing any sort of fears regarding supply. Just testing the 62 level 50 here. It's the high that we saw back in October 27th. We saw it again here in early January, and it's also around the 200 SMA. So we've got a support zone here. If that breaks lower, because we see progress between US and Iran, for example, the 60 level is the next key level to be watching on the downside. However, if we find the talks fail and there's renewed tensions between the two sides, $65 on the upside ahead of 66. Just bear with me. ahead of 66.50 on the upside. If we get a rise above there, that creates a higher high. So I think that is pretty much everything. We'll just take a quick look at Euro USD. We do obviously have Euro GDP data as well. But I mean, given that the ECB isn't really doing anything right now, I think the Euro's USD is being very much driven by USD stories. We've seen the rally, the recovery from the 200 SMA up until the 128.80 high, fall lower, finding support on that falling trend line, and just hovering around that 118 level. The ECB have said that they still see a policy in a good place. There's no sort of plans to either move or on rates anytime soon, but they're data dependent. And the market's just pricing in a 25% chance for a rate cut this year. Obviously, the concerns here are that we did see inflation cool to 1.7% in the Eurozone, which is getting further away from that 2% target. And we've also seen the strength in the Euro US dollar, which again can add in deflationary pressures to the region and to the currency, so that could weigh on the euro. But for now, we're just holding above this falling trend line, which is significant. A break below that, I think, brings the 50 SMA in at 117.25 and 117 round number ahead of the 200 SMA. As long as that holds, levels on the upside, looking for 118.75 in order to push on towards the 120 level. Well, that's everything from me. I hope that you've enjoyed it, and I will see you next week.